Good morning. It's Brian Hale with Mortgage Advisory Partners. Well, this video and newsletter is being posted on Monday the 17th. I'm actually recording this on the evening of the 16th, Sunday night. Happy Father's Day to everybody who's out there who's a father. Had a good chance to talk to my two sons today, and it's always good. I'm actually coming to you from Dromoland Castle in Newmarket-on-Fergus in Ireland. I've been over here for about 10 days and we're coming back on Wednesday. We're excited, obviously. Not only do we have the newsletter above that we post every Monday, along with the opportunity to subscribe to it, but on Friday the 21st, we're launching the weekly roadmap, which is a new service brought to you by Mortgage Advisory Partners. In every Friday subscription call for sales training, speakers, market updates, ideas on improving production with some outstanding speakers. We're going to start this Friday actually with the inaugural guest of Dave Savage from Mortgage Coach, Trust Engine. Dave will be joining us. You may have seen a recent video that Dave and I just posted a few days ago up on my LinkedIn and on Dave's YouTube and LinkedIn channels as well. Above is the weekly newsletter that if you were a subscriber, and we're approaching 2,000 subscriptions currently, if you're a subscriber to the newsletter, you would have got this this past Friday, so you'd be prepared for the weekend with clients and customers. In addition to that, if you become a subscriber to the weekly roadmap, we will include a subscription to our newsletter, and you'll begin to receive it every Friday afternoon, just as a value add to the process. This week's newsletter talks about a big inflation victory, getting rates back to the lowest level since March. Obviously, the CPI number midweek on Wednesday came out better than expected. And in fact, it was reported at 0.2 versus an expected 0.3% on the CPI. But actually, the 0.2 is a rounded number. And the unrounded number was actually 0.163, which if you use that number and multiplied it by 12 to get an annual number, you'd actually be sub 2%, and the Fed has announced 2% as their target. So while 1 month doesn't make a trend, and we're going to need to see additional months to confirm what we're seeing, it was followed on Thursday by the Producer Price Index, which actually came out as a negative number, materially better and lower than expected for its number. And then, of course, the Fed reconfirmed its view that probably just one rate cut this year, and no need to make a move anytime soon. The current view is that likely not until September will we see the Fed make a downward rate cut. It could happen sooner than that, but I don't think so. We're going to need a couple of more months of confirmatory data in CPI, PPI, the jobs number that we'll see at the beginning of next month, and a variety of other inflation indicators, the JOLTS report, and a variety of other items. Coming up this week, by the way, in the newsletter, there's a couple of great charts this week kind of showing what happened on the market in terms of things that have been making the market nervous versus things that made the market happy. I encourage you to take a look at the newsletter. And there's also a great chart in there that shows trending in terms of what's going on in interest rates. I think both of those would be really helpful with your clients and your customers on an ongoing basis to kind of help them understand what's happening. The third great chart that's in this week's newsletter actually shows a revised Fed dot plot that shows how they view, each of the governors view interest rates into the future over the balance of this year, 2025, 2026, and beyond. And the red dots were the old, unrevised. The blue dots in the chart show the revised view. And as you can see, rates are expected to be higher than clearly they were coming into this year and early this year as a result of what we've been going through over the last couple of months with some additional difficult data. In short, we're going to see, we saw the jobless claims data actually come in and help out as well. It came in at 242,000, materially higher than expectation and materially higher than what's been going on over the last couple of months. But the good news is for the first time, we saw rates come back down under 7. The second piece of good news that's actually not in the newsletter but has been out there is that inventory, homes for sale, listings are up materially in most markets, if not all. And in some markets, it's up 25 to 30%, which brings inventory back in. If we can get a little bit of rate relief here, we could have a decent second half of the year. Not great, but decent second half of the year. In addition to that, we have some data coming out this week. On Tuesday at 8:30 a.m. Eastern, we're going to see May retail sales. It's expected to come in at 0.3, which is somewhat higher than the last reporting period. And we're going to see May industrial production on Tuesday as well, which is also expected to come in a little bit hotter than the past. And then on Friday, we're going to see the June S&P Global Services number, which is expected to come in somewhat lower. And we're going to see existing home sales, which are expected to come in at 4.1 million versus the previous report at 4.14 million. Personally, I'm a little suspect of that number. My own view is we're going to have a really hard time making 4 million sales this year on the existing sales side. So, again, great data to watch, important data to watch. I'm actually going to come home on Wednesday. I land back in LA on Wednesday in the evening. I'll be on the weekly roadmap call on Friday morning. I look forward to launching that. We're going to continue to build subscribers on that, and we're going to continue to add and announce new speakers on that weekly call, and I wish you all the best. Hope you all have a great week, and I'll talk to you soon. Take care.